So we're back to continue the conversation with our amazing guest. As you may have noticed, we've been interviewing experts and investors and creators and builders in the DeFi world. We've been recording those conversations and bringing them to you. Hope you enjoy the rest of this conversation. If you haven't caught the earlier part, make sure you check it out on YouTube. Each conversation has multiple parts, so do check them all out. And with that said, enjoy.
Would be helpful for me to go
Dude,
into
let's do it.
details of
So
actually how it works. Okay.
we had David on about a few weeks ago, and he's on the team, wicked smart guy, and he was what he's been doing a lot over the last year was basically shorting against his LPs and keeping his deltas neutral as best as he can. And he's developed some tools and some math on how to do that and kind of, keep it fairly tight. So he's just stripping it off and just simply isolating the fees. And basically, we were using Aave to borrow against it, go short against the LP, and again, keep the deltas as neutral as we can. As we all know, there's a lot of complicated math to do it perfectly, but we were doing okay, and he had an awesome track record of it. So our audience is exposed to, I think, some of that, but again, some of their frustration comes from, well, real time keeping track of their deltas and
Yeah.
remaining neutral, which is easier said than done at times.
Yeah. And so I think that's the complicated thing. So that's actually how Daniel started hedging some of his positions using Aave.
Yep.
So yeah, like
Let's
borrowing and
dive into it,
supplying
dude.
some
I
of those
think
assets.
people are really going to want to see it. People definitely want to know the math. I know that there's interest in actually understanding at least the mechanics behind it.
Okay. Yeah. So how you guys were possibly doing it and how he was doing it was you could hedge out some of the delta on like a full range pool. So, borrow ETH in like, let's say it's an ETH USDC pool, you borrow some of the ETH that's supplied,
Yep.
and then you use that to supply and hedge. And I think
Yep.
there are a couple problems with that is because like shorting on Aave is kind of like shorting a perp. So you have like a fixed delta or a
That's right.
fixed leverage. And then providing liquidity is kind of like selling an option. So in full range V2 position, it's like selling a straddle, and then
Yep.
with V3, it can get much more complex. It's
It's
basically
very
like selling,
complex, especially on the
yeah,
outer edges of that range. It gets very complex to actually remain neutral for sure.
exactly. So it's like selling different types of options, like could be call, cover put, and then different strikes, and then if it goes out of range, then yeah, that becomes
Yeah.
very difficult to like
Well, you're
hedge that
linear and you're
part.
nonlinear. So it gets very complex for anyone, and it's not as easy. So sounds like you guys
Exactly.
started in that, or at least you were exploring some of that.
Yeah. So how it works? Well, I'll take a step back and finish kind of the thoughts on Aave. So yeah, I think the good thing about like hedging with Aave is that there's a lot of liquidity there. The problem is that the LTVs are pretty low, so it's not super capital efficient. You have to supply a lot of capital, and then you can only use a certain amount to borrow. And then the other part is that yeah, hedging V2, but especially like concentrated liquidity, is that your delta's not fixed. So if the price changes a lot, you're going to have to rebalance that and incur some losses and
And a
manage
ton
that
of
position a little
fees
bit more.
for sure.
Yeah, exactly. And then for concentrated liquidity, it's probably better to use like an option to hedge it out, depending on how concentrated you are. So really depends, but yeah, it's because you don't have just delta exposure, you have the gamma exposure. So options being convex, like that's essentially what it means is that it's on a fixed,
You guys can go on the
change in
white paper,
price.
by the way, because I went through it twice today, and you'll see some of these charts and some of these diagrams on your guys' white paper, so they can actually get an understanding of the convex and the curve and all that.
Yeah, maybe
You're welcome to bring it up too. Yeah,
yeah, maybe we can even share my
let's
screen.
do it. So sharing Gammaswap here, just so guys have a bit of a visual here. Yeah, talk us through it.
Yeah, so this is the user interface. So we basically show a P&L chart, and a straddle is a direct short of a full range V2 LP. So uh, the impermanent loss you would experience as an LP is your impermanent gain. But as you can see, it's like a straddle. It's convex. So
Mm-hmm.
that's why your delta is changing. That's essentially
Mm-hmm.
what that convexity means, like an option. So that's why it's so hard to hedge using something like Aave. And then, yeah, if something's concentrated, it's going to be even more exponential than that. So the delta is going to change even faster and it becomes really hard to hedge. So yeah, Daniel was having problems hedging things
Hmm.
out. One was the problem managing the delta, and the other was, oh, if there's like a new token that isn't supported by an oracle, there's no way to hedge it at all.
Hmm.
And so he was trying to figure out a way to hedge that. And so we launched Gammaswap, which is the current version of the protocol. So it allows you to borrow liquidity from AMMs. And how it works is when you open a borrow position here,
Hmm.
let's say it's a straddle, you would
Hmm.
put a deposit and then you get
Hmm.
a notional LP exposure. So yeah, you could put in like 10 USDC or 100 USDC as an
Hmm.
example, whatever you would like. And so you have a notional here. And so to
Hmm.
hedge your IL, you would just match that notional, so that 40K to an LP position. So within a 40K LP position, you'd only need $1,000 to fully hedge the IL. And then your net yield would be the LP supply yield. Let's say it's 15% minus the 3% borrow APR. So you'd be earning essentially around 12%. And
Got
your
it.
leverage, you could be higher leverage and more capital efficient, but you have a shorter time to liquidation. That's the other cool thing about Gammaswap is there's no price-based liquidations. It's based on time. Um, but it fully hedges out the IL for a V2 position. I would say the problem with hedging out, well, I think one of the things we've been struggling with, or where we can actually make the protocol more useful to like a larger cohort of users, is that yeah, managing these positions is pretty manual, and especially like hedging concentrated liquidity positions, which have some of the highest returns. Even using our like interface, you basically have to be like a quant to like figure it out.
Yep.
So what we realized is we saw some of the successful products in DeFi right now are basically like productizing these type of trades. Like Athena was productizing like a delta neutral trade, um, and that got very successful. And we were like, okay, actually ours is even a bit more complex than that. So it makes even more sense for us to launch something like this
Hmm.
because it's a lot to expect like the average person to know how to neutralize your deltas in this way, where it's like convex and it's
I
very
don't even think a
niche.
normal person can do it, dude. Like you need a lot of tools
No,
and computer power to do it
yeah,
very properly. Like if you want to get it tight. Yep.
1000%. So and also like, okay, maybe you can go through the work and figure it out yourself, but like, yeah, like what if you have a full-time job and you're just looking to, passively invest in like an ETF type product? Like those are the things that are doing well, like USC, a productized
Yep.
um, delta neutral trade, Pendle, which is kind of like, yeah, the fixed
Yep.
yields, pretty simple. And these ETF type products, which I would say
Yep.
like are like liquid staking tokens, lending, really simple products to kind of
Fixed yield
just
is super
get a yield
attractive
on,
to a lot of investors right now. Like that,
for
I'm
sure.
excited for that space to keep growing.
Yeah, I think Pendle is gonna do very well too
Yep.
with their new
Me
Boros
too.
product because it's gonna let people do that with perps. But my point being just like these simple products that are abstracted away for people. So we realized, okay, we should do something like this for users, and then also you could have a hedge position that's composable now. So you could put in something like Pendle and get a fixed yield on this type of product that's hedged for you. Or you could put it on Aave and earn a little bit of extra yield on top for lending it out, and it becomes much more, yeah, like capital efficient and usable. And so that's the next thing that we're doing. So it would be, we would basically have vaults that you would get basically like an
Mm.
ERC20 token for depositing into, and it would LP in a concentrated liquidity range on something like Uniswap v3 and use Gammaswap to hedge. So Gammaswap, we work with V2 types of pools,
Yep.
like full range pools to hedge it out. But what we realized is we can still hedge out concentrated liquidity positions too. So there was the straddle on the interface, and then
Yep.
there's
I'll share it
longs and
again.
shorts. Yeah. And so the long and short are straddles that are balanced to be more directional. So to look more like a call or a put. So for example, um, when you open a borrow position, let's say in the previous example, we deposited 1,000 USDC, right? We
Mm-hmm.
got 40K
Mm-hmm.
or 30K in this case.
Mm-hmm.
So that's 30,000 of ETH and USDC that's held in the smart contract. It's
Mm-hmm.
taken out of the LP and held statically. And the debt is in the invariant. So the X times Y equals K. So it's not based on price and it grows with fees. But what we
But repeat that
realized,
one more time. And
yeah,
for people listening, but I'm also masking that with for me as well.
Yeah, so in Aave, the debt is like the price, the price of the asset. Well,
Yep.
just the asset itself. So the value, the
Yep.
price times whatever you borrowed out, that's your debt.
Yep.
Um, in Gammaswap, it's the invariant. So yeah, like the X times Y equals K formula, kind of like the nerdy DeFi side, but how to measure like a V2 pool.
Got it. Got it.
That's the invariant. And
Got it.
so basically, it's the supply of one side of that the pool times the supply of the other is K. And so it's supposed to be this constant that grows with fees. And that's how we calculate the debt. It's a constant that grows with, yeah,
Got it.
the fees. So the
Got it.
swap fees, and also in our case, additional borrow fees that are paid to LPs. Like that's your debt.
Which is a
And so
couple
that's
percent
why,
on your borrow fees.
right, yeah. And that's why we can also not use an oracle because the debt doesn't depend on the price of the assets.
Got
And
it.
so we can support any asset that way.
Got it.
But
Okay.
yeah, what we realized is okay, instead of just borrowing it out in a 50-50 ratio, if we swap some of the collateral, like in the long, for example, if we swap some of the USDC to we ETH uh, in this case, it's a 60-40 ratio, could be any ratio.
Hmm.
We get something that's more directional, and we can actually perfectly hedge a more concentrated range in Uniswap v3 because Uniswap v3, even though it's much more complicated than v2, it's essentially an invariant that's v2 but leveraged. And when the impermanent loss is more directional. So, if you are out of range, you'll either be fully in ETH or fully in USCC,
Hmm.
depending on your range and
Hmm.
what direction it goes. But yeah, it's more
Hmm.
like a one-sided kind of like rebalancing. So this actually is a way that if we use the right ratio, we can hedge any range in V3. So we're using uh, basically we'll LP in something like ETH USDC in a concentrated range, and then we could use a long to hedge and get delta neutral exposure in ETH. So yield tokens that replicate ETH exposure but earn fees over time. And then we could do if we do a short, then it's the USDC version. So it's
Yep.
you would be delta neutral in USDC terms. So you could
Yep.
have USDC but that's earning fees from providing liquidity on chain in the AMM.
Hmm.
And actually is going to be, at least according to like our forecast, like some of the market leading yields. So like 20-25% yield on ETH, BTC, USDC.
I'll take that
So
all day.
really interesting. And then all that complexity is automated away for the
That
user.
that.
So you don't,
Oh,
but
sorry. Go ahead.
I was just going to say you don't have to be like currently the people who use Gammaswap, I'd say, are either DeFi power users or speculators. But there's only so many people that do this full time and uh, can understand this, and that's like a limiting market. And then yes, speculators, I think some of that is fine, but the vast majority of liquidity in DeFi and in TradeFi is in these kind of like low risk
Yep.
principal building strategies, right?
Yep.
Like in TradFi, it's like bonds, and then the stock market, and then like options and futures. They have a lot of volume, but they're not nearly as liquid. And
Yep.
same thing in DeFi. Perps have a lot of volume, but the highest TVL products are the low risk passive strategies like
Yep.
Aave, um, EtherFi, Lido, uh,
Yep.
kind of like the ETFs of DeFi.
So that wraps up today's conversation. If you have any questions for today's guest on any topic we discussed, or maybe topics we didn't discuss, do leave them in the comments below. If you have a recommendation, or if you'd love to see someone on this show, from a guest, from an expert, from an investor, from maybe someone who's built or is involved in a protocol, do let us know in the comments below. And again, if you enjoyed, like this video, subscribe to this channel, and we'll see you in the next.